Good afternoon and welcome to the Peters MacGregor Global Equity Update. My name is Alex Haynes, Head of Distribution. With me today is Michael Haddad, our Senior Portfolio Manager, along with Nathan Bell, our Head of Research. Michael and Nathan will provide you an update on the Peters MacGregor Global Fund, the key holdings within the portfolio, our view on global markets, and also work through a short case study of some of the global bank holdings the portfolio contains. The webinar will run for approximately 30 minutes and we will then have Q&A at the end. Just bring up the mandatory disclaimer. There we are. And the other news I had before I handed over to Michael was 2 points. The first being that the Peters MacGregor Global Fund was recently awarded an approved research rating with Zenith Research, which we're very pleased about. If anyone would like a copy of that research, I'll have my contact details at the end. And the second point is that the price of our fund is now at 1.35%, net inclusive of GST, which reduces the fund's price down from 1.41%, which is also very good news. We will continue to review pricing of the strategy as the fund grows. With that, I'd like to now hand over to Michael.
Thank you, Alex, and thank you everyone for joining us today. I'll just give a brief overview of the fund. So we're running a concentrated portfolio of 15 to 30 securities. We construct the portfolio in a benchmark unaware, completely bottom-up fashion. We're seeking to own a portfolio of good quality businesses with good management that we purchase at a material discount to our assessed valuation of at least 20%. We'll exit at full value and use funds to rotate into more attractive opportunities. The product is generally unhedged, and those are the details there in terms of daily pricing and management fees. In terms of performance, the update to the end of December, we have slight outperformance over a 6-month period. Over the 1-year period, we're under the market by about 1%, and our 5-year numbers are similar at minus 0.7% compared to the market. What's important to note in terms of performance is that we're very glad with how we've tracked over the last few years in this very strong bull market. So we're a value-oriented manager. We're looking for opportunities in names that have been neglected by the marketplace, where there's perhaps been some bad news and complex situations that are misunderstood by market participants. And these sorts of companies don't tend to participate to the same degree as the hot stocks in a very strong bull market. What we've seen over the last year or so is some dispersion in the market and a narrowing of performance. So a very small number of companies are driving the market higher. So if you look at companies like Facebook, Amazon, Netflix, these companies are very strongly. Amazon and Netflix are up over 100% over the last year or so. And these companies have gone from 50 to 100 times earnings, and we think are quite dangerously priced. This has been driven to some degree, we believe, by the weight of money coming into the market via exchange-traded funds, and we think that this is leading to an ideal setup for stock pickers moving forward. So at some point the piper will need to be paid, and we think there'll be a sea change in the environment. So we feel very well positioned with our existing portfolio. We've got some good businesses at very attractive pricing. We've got some cash at hand that we can utilise to take advantage of opportunities as they present, and we're really glad that we've been able to broadly keep pace with the market over the last 5 years, and that's been on account of strong stock selection within the portfolio. With that, I'll hand over to Nathan Bell, who'll speak a little on the bigger picture.
So there's a few themes running through the market at the moment, and we've just tried to pick out a few that we're getting asked about. We've seen the market pull back quite a lot, particularly in the last month or so, but also towards the end of last year. We've sort of seen, early on it was quite strong, the market, but then as the year wore on, we had that sort of mini collapse, if you like, in August, and then sort of rally up towards Christmas. Now, through all this, you would think that there might be the time to really put your portfolio to work and be buying up all these sorts of great companies. But the fact is, the pain in the market so far has been quite restricted to the energy sector in particular and other companies that are very highly leveraged. Now, we don't tend to buy companies where things like the oil price have a huge determinant on your business. We prefer companies where business and management can actually be in control of their own destiny. So although we still have to be very selective, I think a really important point to make is that although it's still not a particularly easy market for value investors, when we set out each year, we don't know what sort of opportunities are going to head our way during the year. And if we look back last year, so 12 months ago, I've put 3 stocks there in the slide of companies that we didn't own. So it was Liberty Media, Rolls-Royce and Precision Castparts, which we're going to talk more about shortly. Now those companies, we didn't know that those companies were going to become cheap, were onto our radar at this time last year. And I really feel like it's the same situation we are in now, is that we don't know what opportunities are going to come our way this year, but it's about being selective and about being patient. This isn't the time where we think passive strategies are going to work, because overall the market still looks quite expensive. But what we need to do is just take advantage of other people's mistakes, and when we find those really good businesses that are cheap, just take advantage of them, and we know over 1, 2 and 3 years there'll be plenty of opportunities. So as Michael already explained, there's a few mega caps that have really carried the market, and if you actually have a look at the market with S&P 500 outside the top 10 stocks, and the actual returns, I think we're about -2.5 or -3%, and you can find many stocks that are down well over 20%, so into official bear territory, but so far not many of those stocks are the ones that we want to own. Value investors had a really hard time of it. If you have a look at some of the great investors in the US, people who have built 10, 20, even Buffett with 40-year track records or 50-year track records, their returns last year were extremely poor, ranging from anywhere from minus down 10% to David Einhorn was down 20%. So these sort of value plays haven't really been working out lately, and what we've seen is growth has been way outperforming value investment managers. Now we've got to a point, as Michael explained, that we think now the strategy is going to come, it really, maybe say it again, the environment for value investors from here should be much better, because valuations are so stretched. There's a lot more room for disappointment. So it's our job to make sure that our stocks on the watch list, we're keeping an eye on them, and as the prices come down, as they have been over the last week in particular, that we're taking advantage of those opportunities. And the other thing we're seeing is increased volatility. Now I know volatility tends to scare a lot of people, but for a value investor, volatility really is your best friend. If we want to buy stocks, if we want to make money from stocks, then we need to buy them cheaply in the first place. So we're actually quite excited about the increased volatility in the market, because what you tend to get is that when markets come down, there's a lot of, as we say, the baby gets thrown out with the bathwater. So there's a lot of stocks that are under pressure for the right reasons at the moment, but what we're really looking forward to is a lot of businesses that actually have nothing to do with oil prices, potentially becoming cheap just because people are pulling money out of the equity market for reasons other than value. And that's really what we're focused on, is just the value of the businesses that we follow. There's a lot of macro stuff going on at the moment, a lot of macro concerns, and we could probably sit here for an hour and talk about them. I've just picked one out because it's probably most important to our portfolio. The course of US interest rates has global repercussions because the Fed really is the central bank to the world. I'm going to talk about the bank shortly and how the US interest rate situation plays into that. But it's interesting, towards the end of last year, people actually thought or believed in the Fed that they would have 4 quarter-point interest rate rises this year. And now you've actually seen the yield curve starting to flatten, and now that belief has gone, and that's put pressure on bank share prices in particular. But I think that's one of the big macro things to think about. Potential devaluation in the Chinese yuan is another. But again, we're trying to buy businesses that are in control of their own destiny, so it really doesn't matter what the macro environment is in the short term, that these businesses are providing products and have pricing power through the cycle regardless.
Thank you, Nathan. I'll just give a little snapshot of the portfolio. So this is the top 10 holdings as at the end of December. In terms of some of the changes, one stock that we've held for some time is Fiat. We made Fiat a relatively full position size in 2014 at a very attractive price. That company's performed very well over the last year or two for us. We've pulled that back to maintain a relatively full position at around 6%, but since the end of the calendar year, Fiat's spun out Ferrari, and Nathan will speak to that shortly. But as a consequence, we've sold Ferrari, which is not interesting on its own due to valuation. Very good business, but very fully priced, and we now have a 3% position in Fiat. We've boosted our holding in Liberty Media. So our Chief Investment Officer, Wayne Peters, and analyst Trevor Scott spent time in North America meeting with Liberty Media, and as a result of our meetings with various executives in the company, our conviction has been boosted in that name. So we've added to the position there. We think it's a very attractive business. Michael Hill's become a larger holding at 8% of the portfolio. That's as a consequence of having bought more shares in the company in late 2015 at a very attractive price. That stock's since bounced back up somewhat and has brought the holding up a little. Michael Hill's a long-term holding of ours, an exceptionally well-run business, a very strong franchise in the jewellery retail industry. Some interesting news with the company is they're currently exploring the potential to list on the Australian exchange. They're currently an Australian company but listed on the New Zealand market. They have franking credits that they attach to their dividends for Australian shareholders, but they don't have imputation credits for New Zealand shareholders. So in terms of the shares being valued in the New Zealand market, we've felt that they've been at a significant discount due to the tax inefficiency. If the company is able to relist on the Australian exchange as a mid-cap company that would be in a space that's very well picked over by the market, we think there's a good chance that stock could be re-rated over time. One other company I guess to speak to would be Rolls-Royce, which we've bought this past year. We've been a little early to the party with Rolls-Royce. We think it's a very strong business, a very strong franchise in the manufacture of jet engines. The company's got direct and indirect exposure to the oil price. The most interesting aspect is that with the price of oil and jet fuel falling as much as they have, the economics of purchasing an old jet that had been previously mothballed out of the desert and refurbing that jet makes a lot of sense compared to buying a brand new jet. So you can get an old jet refurb for about a fifth of the price of a new jet, but that jet will be fuel inefficient. So when the price of oil is low, that may make sense, but that's not a long-term solution. So we believe there's going to be pent-up demand with that company, and we think it's very attractively priced where it is today, notwithstanding having been a little early to the party.
We've finally got some good news from the company too. Every time we get an email from this company, your knees shake at the moment. But it received a $2.7 billion order for new jet engines, which was great. And also now because Iran actually looks like it needs to completely replace its entire fleet of planes, which is about 500 in total. And already there have been orders going out to Airbus, and Rolls-Royce actually has a monopoly on a couple of their planes. So that's very good news for Rolls-Royce as well.
Mm-hmm. All right, and Nathan, perhaps you can speak to some other changes in the portfolio.
Yeah, so I'm just going to pick on the two main changes. The first one is, as we knew probably about 5 months ago now, Berkshire Hathaway made a takeover offer for Precision Cast Parts. Unfortunately, we didn't get a full position. We were still buying at the time of the takeover offer. And you'd think we'd be quite happy with making, it was about 20% on our shares at the time. But when you're a long-term investor and you're in a market that's quite expensive, we thought we were going to be able to own this company for the next 10 years. And although we own Berkshire, so we'll get a little bit of benefit from its ownership of Precision, that takeover settled last week. So we've received the cash for that position and now looking to reinvest. The second part there is Fiat Chrysler selling off its position or remaining shares in Ferrari. It sold about 10% towards the end of last year, and then the remaining 90% listed in January. Now, Ferrari actually has what I think is a very good business model. One of the things that it does very well is it has this pent-up demand, and because it doesn't produce many cars, actually only produces about 7,500 cars per year, even in a recession or an economic downturn, there's still demand for the cars because people are still waiting for their orders to come through. And if you have a look at every single special vehicle that they've ever made, it's actually outperformed the S&P 500 over that time, which is quite remarkable. It shows you that we're not really buying the average car, which depreciates as soon as you drive out of the yard. And people often say that you're actually buying a piece of art in the way they appreciate. We just think it's a wonderful brand. The problem was by the time we got our shares and were in a situation where they were liquid, the share price was about $48 and it was trading on a very big multiple. I think it was over about 25 times earnings. So even though this was a wonderful business and it had plans to grow its annual production from about 7,500 to 9,000 over the next 3 or 4 years, we just thought it was just far too expensive. And so we sold those shares, and that combined Fiat Ferrari position is now down to about 3 or 4%. Sometimes you get lucky and you look very clever, but Ferrari after last night is selling for about $35 per share. So far that's been a good decision. I think it's a very good company, and it's one that still stays on our watch list. And if we get a cheap enough valuation at some point, then we'll look to re-add it to the portfolio.
I might just add to that as well, Nathan. We really feel that our sweet spot is with these complex situations. So with Fiat, when we bought the company, you look through to the underlying assets of that company, having a business of the quality of Ferrari in there, we felt it was mispriced. Similar dynamic with eBay and PayPal. The market was really focused on the marketplaces business for eBay and overlooking some of the inherent attributes of PayPal, which we felt were more valuable than those of eBay itself. And same with Amoco and U-Haul. So U-Haul is a very, very valuable business franchise in the US. We bought that through its holding company, which is Amoco. And again, complex situations and interesting opportunities. Perhaps Nathan, you can speak also to the banks. So
we've got about 16% of the portfolio invested in these 4 banks. I'll speak to the 2 US banks first as they reported their quarterly and annual numbers recently. Wells Fargo, in contrast to the other 3, was never really a self-help story. Wells Fargo really is just one of the best banks in the world, and you can really think about it as the Commonwealth Bank of Australia in the US, just because it by far and away has the highest returns on equity. It's a wonderfully well-managed business, and it never really had any trouble through the GFC, and it was actually made what many people actually call one of the greatest acquisitions of all time. So instead of being a traditionally West Coast-based bank, it actually became a national bank, and it continues to set records in terms of earnings per share. So it wasn't a self-help type situation, but we just thought this was a wonderful business. Everyone was worried about too big to fail in the past, but now you've actually got even too bigger to fail, because these banks have consolidated their market positions, and Wells Fargo now has well over $1 trillion in deposits. And the way to think about how valuable those deposits are is they're actually costing the business a bit of money at the moment because interest rates are so low. It's actually interesting to see JP Morgan has stopped taking a lot of deposits because it doesn't want the short-term cost. But Wells Fargo actually sells on average 8 products per customer. So it's prepared to wear this short-term cost, because in the long term, if it can even just sell 3 or 4 products to these new customers coming on board now, then that's how you're going to get earnings growth no matter what the macro environment is like in the future. So we don't own Wells Fargo because we think in 1 or 2 years there's going to be a massive increase in cash flows or dividends, in contrast to the other 3. But this is just a wonderful franchise, and we think will continue to dominate its market for many years to come. Bank of America has been a bit of a self-help story, where we really needed to get the huge litigation behind the company for 2 reasons. One, we just needed to know how much it was going to have to pay out in fees or claims from having gone through the courts. And the other was because they just had to hire so many lawyers and other people to deal with old legacy loans and to represent them in court and fight these battles. So what we've seen so far is the amounts have been agreed, and in 2016 Bank of America's earnings will in large part be free of those legacy issues. These two banks, Wells trades on about 11 times earnings, and Bank of America has a PR of about 9 or 10 after last night's falls. So we think these are very attractively priced at the moment. Both of these businesses have over $1 trillion in deposits. They have lots of cross-selling opportunities, and there's a chance for Bank of America in particular to increase its return on equity to something not in line with pre-GFC, but even if you can get up to a 10 or 11%, then based on trading at about 0.9 times book value right now, then we know we're going to make money. Now, the other two banks, you can almost think of Lloyds and RBS as Bank of America, but quite a few years ago. Lloyds is actually very clean now. The one legacy issue that Lloyds is dealing with is payment protection insurance, or PPI. So this was insurance that Lloyds sold mostly to mortgage customers pre-GFC, and basically the story was that they should have either never have sold the insurance in the first place, or they overcharged for it. And Lloyds has taken about £14 billion in provisions for potential payouts so far, and it looks like we're still waiting on a final announcement from the regulators, but so far it looks like people have 2 more years to make claims. No one's sure how big those claims will be. Maybe Lloyds might not have to take too much more, or maybe there's another $1 billion or so to go. No one's really sure. But what we do know about Lloyds is, again, this is like the Commonwealth Bank in the UK, and the UK market is actually much or very similar to the Australian market. People borrow in the same way with variable loans traditionally. There's only 4 or 5 banks that dominate the market, and Lloyds, just over RBS, has the highest return on equity business, which is running at about 16.5% on an underlying basis. So this is a business that's rock solid, produces plenty of cash, but at the moment, because it has to keep taking these provisions for the PPI, we're not getting the full, as shareholders or owners of the business, we're not getting the full extent of that cash flow coming to us through higher dividends. So that's what we're waiting for, and over the next couple of years, we fully expect that to happen and the share price to go up with it. Royal Bank of Scotland is probably like Lloyds, but about 3 years behind. Ross McEwen, who you might have heard of, who used to be involved with Commonwealth Bank, he's running the show there. Now, he's got quite a job in front of him in the next 2 or 3 years to basically get the business back from selling products in 20 countries back down to 6. And its underlying retail franchise in the UK is first class, and it really is only just behind Lloyds if you think about it in terms of a return on equity basis. So everyone knows that's a wonderful business under there, but not everyone is prepared to stick around and wait for Ross McEwen to start selling off some of these businesses and start getting that underlying earnings power, really pushing cash flows, and then we'll start to see higher dividends. And the thing that's a little bit unique about the UK bank still is that Lloyds still has a government ownership of about 10%, and it's recently delayed selling off that last 10% because of the recent share price falls. But at RBS, that shareholder ownership is more like a bit over 70%. And the government's getting pretty keen now to start selling off some of those shares. So we saw RBS announce some write-offs last week, and we expect the company to move pretty quickly over the next couple of years to start getting back to its underlying retail franchise and start paying out much higher dividends.
Okay, so with that, I'd just like to open up the floor to any questions anyone might have on the content presented today. Well, it looks like we've got a couple that have just coming through now. Let me have a look. The first, this is a common question. How does Peters MacGregor manage exchange rate risk?
Right, I'll take that one, Alex. So we look at currency on a look-through basis in the portfolio. So we look at our companies, we look at where the underlying revenues and earnings streams are. Our approach to currency is to be generally unhedged, but we have the capacity to put some hedges on. And our approach would be when the Australian dollar is materially and obviously undervalued on a range of fundamental measures. Then we would look to put some hedges on. We're looking at items such as terms of trade, purchasing power parity, and interest rate differentials. More philosophically, if I may, I think it's worth remembering that we own international shares. That's a part of people's overall portfolios, and it's appropriate to have some international diversification of currency as well as the underlying shares. We have our homes, our businesses, our incomes, our social lives are all tied to our home economy, so it makes a lot of sense from a risk mitigation perspective to have some foreign currency exposure.
Can we just have another one come through? Have the benefits of investing abroad disappeared with the Aussie dollar falling to 70 US cents?
So I think what's underappreciated sometimes is why you actually want your international exposure. And, yes, we think it's very important. Australians tend to be very underinvested abroad. Most of the assets, that I've seen from the average portfolio is like 1 to 2%. Now Australians are travelling more, and Australia is part of the global marketplace. And if our currency doesn't go the way we want it, then we end up paying higher costs, but we just don't notice it when we buy things. So we think, yes, it's definitely worth having some currency, international currency exposure to maintain your purchasing power abroad. Particularly because Australians probably aren't noticing too much unless they're taking a holiday overseas lately, that we just lost 30% of our purchasing power over the last year or so. But that's not the only reason to invest abroad. And investing overseas, you should be able to find more of the sorts of opportunities that we look for in Australia. So if you're looking for those high quality businesses with reliable recurring revenue streams, where you've got entrepreneurial management with skin in the game, top quality balance sheets, you should be able to find more of those businesses over time at attractive prices on overseas markets. And I think one of the other attractions too is if you look at Woolworths now in Australia, we just don't need any more Woolworths in Australia. And with Coles opening and Audi and potentially Lidl coming as well, that space has just become so competitive. And this sort of wonderful flywheel that Woolworths used to have of just opening new stores, that's essentially gone. And now it's having to cut its prices to get people to the foot traffic back in the stores. So you've got this business that's really stuck with revenue growth, or stuck for revenue growth, and now having to cut its margins and hope more people come back. Yet a lot of people have actually moved to Coles and don't have any intention of going back to Woolworths because their stores are much nicer. And now Woolworths is actually stuck for a strategy. It actually doesn't know what to do. Whereas if you go overseas, you'll find a lot more strategies or businesses that can actually expand around the world. So America is obviously a much larger population than what Australia's is anyway, but then you can go to overseas markets with confidence, in contrast to a lot of Australian businesses that have taken big jumps overseas and come back with their tail between their legs.
I think we have time for one more question. How would slower growth in China impact the portfolio?
Yeah, what I would say to that is there are a lot of things to be concerned about in the world from a macro perspective. Far and away, though, our focus is on the fundamentals of these interesting companies that we're analysing. We believe there are definitely risks in China. There's risk around capital investment in China, but there's a huge emerging middle class in China who are going to be spending more money in 10 years' time than what they're spending today. So there's a huge opportunity in the global markets with consumer growth, and we're just really focused on finding good businesses with good management that can hopefully capitalise on those very long-term trends.
We've also had a look at a number of businesses in China. It's hard to find those sort of great businesses with great management, and just because a lot of you don't find sort of businesses that have been around for very long. They're quite new businesses. There's a lot of state ownership involved with the business. The markets are highly regulated, or the government comes in and chooses the winners or losers. So it's, even though the markets have come off a bit there, we haven't invested anything there, but there are going to be some wonderful franchises to make a lot of money in China. So while we certainly look at our portfolio on a regular basis for any particular risks from China, we're also very alert to any opportunities that it might provide in the future as well.
And we've got one last question coming in here, Nathan, you may speak to briefly. Can you please clarify again the expected future revenue/profit sources for the banks and what impact on profits if interest rates don't rise?
Okay, so I won't do it for every bank, But just to give you an example, Bank of America, if we saw a parallel 1% increase in the yield curve, then the company currently estimates that would provide $4.2 billion in pre-tax profit. So the interest rate leverage for Bank of America, I think, is probably the highest of all the banks in the US and is absolutely meaningful. But at the current price, we don't actually need higher interest rates to make money, particularly after the recent falls, because what we're doing is, say with Bank of America, you're buying it at 0.9 times book value, and you're getting a return on tangible equity of about 9 or 10%, and provided the economy holds up and there's not another massive housing collapse or anything like that, you're going to get that 9 or 10% return every year without having higher interest rates. And then if we do get higher interest rates, then that will be the gravy on top. But I think if you get to something more like, let's just say $20 for Bank of America, which would be somewhere close to book value, not tangible book value, then I think you're going to need higher interest rates to get towards $25 or $26 and really make a lot of money. But at the moment, we don't need to worry about that because we think it's cheap enough as it is.
I'd like to thank everyone for their questions. We had a couple more come through. We will address those offline. Due to time, we'll draw to a close. I just want to again thank everyone for joining us today. If you've not registered already, I'd encourage you to sign up for our News and Insight service via our website. Just remind our audience there's a number of ways you can access the Peters MacGregor strategy, either via our pool trust, or if you have clients that want direct share ownership of the actual strategy, we offer a separately managed account administered via Mason Stevens, and we also offer individually managed accounts, and I'm happy to supply more detail about that. Again, if you've got any further questions on the content presented today by Michael or Nathan, please send them through, or any other feedback. And again, I'd like to thank you for your time. Thank you.
Thanks, everyone.